Well, just a few weeks left to go in 2023. The street's feeling pretty optimistic about the market's direction in the new year, but there's still a lot of uncertainty on the horizon. The timing of interest rate cuts and whether that long predicted recession may finally materialize. Two key big issues that investors are looking at. So what should the average investor keep in mind as they prepare their finances for the year ahead? Let's bring in Anthony Saccaro, Providence Financial and Insurance Services President. Anthony, it's good to talk to you. We've seen this huge momentum coming through in the markets since the Fed's decision last week. I mean, Fed officials would argue that maybe the market's getting a little ahead of itself, but I'm curious how you have framed the investment case going into 2024 on the back of the Fed decision. Has anything changed for you fundamentally?
No, fundamentally, everything is still the same. I think investors, the average investor would be smart to stay with the tried and true method of dollar cost averaging over time. I'm glad to hear Jared's report that the stock market investors are up at this point. I think he said something like 60%. I think that's where you want to be if you still have another decade and a half or 2 decades until retirement. Dollar cost averaging drives the average purchase price down. You're buying over and over and over. It's the same dollar amount, buying the same investments, regardless of the price of the investment. And what that has done mathematically is it lowers the average purchase price. And that's what you want to do, is you want to buy low. The fear that I could have at this point is the fact that people are feeling somewhat confident with what's happened in the market this year and what's happened in December. There was a lot of green on Jared's board. And I also don't want people to stray. This is crypto spring, as Jared talked about, right? Crypto market's done well. I don't want people to think, okay, well, maybe that's where I need to be. Let's quit dollar cost averaging. Let's quit doing the tried and true methods. Let's go put some money into crypto. No, I think that would be a mistake. You can put a small amount there and an amount that you could afford to lose, but stay with the tried and true. That, I think, is going to be the most important way to build wealth in the long run.
And actually, a lot of people have been waiting on the sidelines with cash in hand or had it in some of these shorter term funds as well, but they're trying to get in here, trying to sort of chase everything in this everything rally. How should they pick the best opportunities in this sort of environment?
Yeah, well, you have to be careful as well because we're not out of the woods yet. This recession that seems to never have come, I don't know if we've been talking about it now for a year and a half or 2, but somewhere in that range, it still could materialize. We still have an inverted yield curve. We can't forget, inverted by about 50 basis points. And that's always been a good predictor of recessions. So someone with cash on the sidelines shouldn't just try to find that one moment in time. That's a fool's errand, trying to figure out, okay, I'm going to put it all in. If you've got cash in the sideline, I think there's 2 things to think about. One, if it's short-term cash, money that you're going to need in a year or 2 or 3, leave it on the sideline, take advantage of the higher interest rates while you can. But if it's longer-term money, what you don't want to do is you don't want to have a short-term asset, which would be like a money market or a short-term CD paying you now. You don't want to have a short-term asset to be funding a long-term liability, your retirement plan. So you should be dollar cost averaging that money into the market over time, not just trying to pick one point and get all in, but dollar cost average that money in over time, maybe over the next couple of years. That would probably be the right way to get in.
Anthony, bonds have been a pretty good place to be in if you consider where we have been the last several months at least, but we've seen a significant pullback in treasury yields. Looking at the 10-year right now below 4%. Is now the time to maybe start shifting over more exposure to equities if you haven't done so already, given the expectation for the Fed now? Some are expecting 3 rate cuts.
Yeah, so I do think that yields going down is certainly going to drive the desire for more equities. Higher rates are going to compete against equities. Lower rates are going to help equities. So it's not a bad time to continue shifting. But I think it does go back to what is the purpose of your money. If your money is for longer term, dollar cost average your money out of the shorter term money markets and even the shorter term bonds and into stock market, which is going to be designed for the longer term. But I don't want you, if you're a younger investor, to get all out of bonds completely because yields could still go down. If we have a recession and rates go anywhere to where they were, 6, 7, 8 years ago, then the fact is, actually even 2 years ago, then the fact is that's going to be good for the equity market. It's also going to be good for the bond market. So although bonds aren't as good as they were just in the last couple of months, if you have some percentage of ownership in bonds, when the rates go down, you're going to get some capital appreciation too, in addition to locking in decent yield. So I think as a younger investor, having, maybe 30, 40, 50% in bonds is probably a good strategy as well too. Lock in higher yields and potential for capital appreciation in the next year or two.
And Anthony, speaking of what will be happening in the next year or two, obviously we have elections, still have a lot of geopolitical conflict at the moment. What do you think are going to be the biggest macroeconomic influences outside of what the Fed is doing?
Well, I do think the Fed is going to have some influence there. I think what happens with inflation is going to be a big deal. We don't know what's going to happen. Inflation's come down from its high of 9.1% a year and a half ago. Now we're in that 3% range. The Federal Reserve wants it down at 2%. And that last 1%, I think, is going to be really, really tough. But we're headed in the right direction. So inflation certainly is going to be a big deal. The wars are certainly going to be a big deal as well, too. It's amazing to me how much the market has kind of just shrugged off the wars going on. We haven't heard about Russia in a long time. Israel is the war that, all the news was about when that first started happening. And it's almost like the market's not caring. Well, there are still very big reasons to care. And I think you don't want to let your guard down now. You still have to be vigilant. We still have a recession around the corner, potentially. Don't just go all in thinking that everything's good, because there could be a lot of problems next year and the year after.
Certainly not out of the woods yet by a long shot. Appreciate you taking the time to join us. Anthony Saccaro, Providence Financial Insurance Services President. Thank you so much.
Thank you.